Good morning, one and all present here. Am I audible?
Chinat, all good.
All right, thank you. Good morning, one and all present here. I welcome you all to the 97th webinar of the Saturday webinar series by Managed CIA. I am Zenith, working as content developer at Managed CIA. A brief about our center. The Center for Innovation and Agripreneurship is a center of excellence hosted at the National Institute of Agriculture Extension Management. It's one of the leading agribusiness incubators in the country, and Managed CIA has mentored 503 entrepreneurs and incubated more than 310 startups from various focus areas of agriculture and light sector. The topic for today's session, as you all know, is managing finance and cash flow for active startups and how important it is. And to throw light on the topic, we have two speakers with us. Our first speaker for the day is Mr. Satish Chandra Chintamani. He's the Executive Director at Institute for Agriculture Technology and Finance Management, and he specializes in research in the field of agriculture, finance, and management, with rich experience in capital budgeting, investment setting, risk management, recovery, credit monitoring, valuation of agriculture property, project, and business. He has also been associated with the startup ecosystem. I request Mr. Satish to take over the session, and I'll be making you presenter in a minute. I request all the attendees present here to use chat box to put their questions to the speaker, and we'll be taking up these questions during our Q&A round. Over to you, sir. I have made you the presenter.
Wonderful. Um, Good morning to all of you, and very nice meeting you all on this forum. Now, let's take straight away to the objectives, finance management, and cash flow in as simple manner as possible. There are three principles that we need to learn and hold on to.
Sir, may I request you to make it to full screen, the
I'll
PPT?
do it. I'll do it. So
Yeah,
there are
all right.
three paramount ratios or three paramount principles that you need to follow in finance management. It is very simple. I'll try to make it as simple as your regular day-to-day life. Now, let us try to understand what creates 1 minute. Just a minute. What gives value? What gives money? So an idea can give you money, a product can give you money, a service can give you money, and an effort can give you money, provided there is utility. There is utility for whatever you create, whatever idea you have. And that utility should have best use and highest use. Best use in the sense, suppose I give you 100 rupees. If you use 100 rupees to do very creative work, then it is called the best use. Highest use is consuming the entire 100 rupees. So the question here is whatever utility you create, whatever idea, product, or service or effort you put in, it should create a utility. The moment you create a utility, it should have demand and you should be able to supply to meet that demand. So it can be a part of the supply system, or you should be able to meet this demand that has been forced by the market. Lastly, it should be legal activity. It should be legally permissible, legally admissible, and legally transferable. So the idea, product, service, and effort, if it cannot be legally transferred, it is of no use. It cannot create money. The simplest example is a stone is lying in front of your house, a huge stone. At this moment, it's useless. We don't know who has created it, sorry, who has dumped it there. It is just lying there. So one day, one crazy artist comes and carves a picture or a beautiful idol out of it. So now, the moment he created an idol out of it, there is demand. Everybody wants to have the idol in his house, or he wants to buy it. And the guy who sculpted it, he has gone away. He doesn't claim any ownership on that. Now, there is no ownership for legal sanctity for that stone. Everybody is quarreling. So now you see a useless item was created into a demand by sculpting, and now there is a legal issue. So legal issue is sorted out if the government takes over and auctions it. Oh, now you see the system of understanding how to create money or how best a startup can plan their work needs to come from these three aspects. Now, what exactly we are intending in terms of money with startup? The very intention of startup is to make money, make money, make more money, more money, more money. In the process, create value. So we create an impact with our startup. We create an impact that impacts the life of large part of the community, and it brings about a permanent change. That is the objective that is expected out of a startup. So when you say you want to make more money, money. So you need money to make more money. So this is all a simple class flow of thoughts with respect to an enterprise, a startup, or any business. Now, finance management, cash flow management, everything starts with 3 to 4 questions. First thing is why? Why do you need money? And then when do you need money? How much money do you need when you want it? And who gives you money when you want it? If you know these things, your cash flow is ready. As simple as that. But then let us try to split it up a little bit more. Why do you need money? Let's take, for example, when you want to buy a bike when you were a kid, or when you were going to a college, you wanted to buy a bike. Where do you go? You go to a consultant. Which consultant? Your mother. You go and tell her, Mommy, I want money to buy a bike. She says, even before you ask money, she says, why do you need money? So the question of why came in. Then she asks, when do you need money? And then you say, how much? And she asks, how much money do you need? And then she says, she goes into technicality, which bike you have planned. So you will go on explaining to her the technical aspects. Then she decides who will give money. Or either her husband, or her father, or someone, or she herself will try to give you money. So these are the 4 questions which you have to answer in order to bring about a beautiful cash flow in your system. So there are only 2 sources of money in the world. You go anywhere in the world, there are only 2 sources of money. One is your own money, the others is the others' money, someone else's money. So you need money to create more money. Suppose you don't have your own money or your own savings, your own hard-earned money that you have kept as a reserve, then you depend on others' money. So the others' money comes in 2 forms. One is an investor money, the other one is a business lender or a bank, a lender. Now let us try to look at what differences they have. The moment you bring in an investor, he not only gives you money, but he takes away part of the ownership. Whereas the lender, he has no interest in the ownership. He only wants return of his money and return of interest. He does not want ownership until a serious default occurs. So this is how simple it can be. Even in your balance sheet, when you look at it, there are only 2 parts. One is your own money, the other one is others' money. The left-hand side, you will see your own money that's represented in the form of capital and reserves, and remaining all completely lending or others' money that you see in the balance sheet. Now, the first principle of finance management is if you have 1 rupee as capital, you cannot borrow. I'm making it very clear, borrow. That is total outside liability that you owe to all people in the business should not exceed 4. So the ratio, first golden ratio is your capital should be 1:4 times the borrowing. 1 time capital is 4 times borrowing is the maximum you can have. Maximum. So if you cross 4 and get into 5, you will be automatically into a state called sick unit. And then you go into 5 to 6, you require a serious attention or surgery. And if you go into 1:7, it is like brain dead kind of a situation, which requires a serious attempt or surgery to bring it. Most of the times, it may not happen. It will be very difficult exercise. It goes into insolvency, it goes into several levels of rehabilitation and restructuring. So, first rule is whenever you start a business, you ensure that you have enough capital so that if you borrow, it doesn't exceed 4. Lesser the ratio, better it is. So this is all you need to follow in the first stage. So this calls for what we call as capital growth. As you do business, you should create more money, more profits. Forget about taxation. Taxation is a part of life. So you need to focus on how best I can improve capital, how fast I can become a debt-free company, or I grow in terms of my own capital. So when we say this, automatically you need to ensure that you have a good trade or good business in terms of sales and profit margins. So all these are taken care of if the ratio is maintained between 1:4. This is the first foremost ratio that you need to protect. This is a paramount importance in your balance sheet. Capital and reserve should be 1. Borrowings should not be more than lesser, the better. Now, the question when you need money, why do you need money, leads to simple other questions. Why do you use the money? Is it a short-term use, or you want to buy something that has a quick use, and then it turns that quick use into money? So within a short period of 12 months, whatever money you have flowed in will come back to you in the form of cash and more cash. So this is called short-term use of money. And then we have a long-term use of money. Suppose I borrow money for buying a motorbike, I am using it as a long-term use. So it's a long-term use of the asset. So you are classifying your Y into short-term Y and long-term Y. Why do I use it? Where do I use it? Do I use it in a short-term function or a long-term function? Short-term function is like it generates money in ripples, pulses. Like within 12 months, you can have money generated hundreds of times if you are intelligent, minimum 4 times if you are a normal businessman. So the turnover, what we call as recycling of money or short-term money or short-term use, happens a minimum 4 times. And in a long-term case, it spreads between 12 months to uh, 120 months, sometimes 40 months, sometimes 360 months, especially in housing loans. It can go up to 360 months, 30 years repayment if someone gives. Now, let us try to understand the long-term and short-term uses. See, the question is when you need money to classify your use into short-term use and long-term use, so you treat them separately. So long-term means usable, repayable, or recoverable in a period beyond 12 months. We classify them into medium term, long term, and deep long term. Medium term means up to 5 years. Long term means beyond 5 years. Deep long term is beyond 10 to 15 years. Now, short term use is something like you're recycling many times over, recoverable within or before 12 months period. You're repeatedly using it. It is nothing but most of the time short-term use is working capital. Working capital or funds that you use in development of in production process. And you develop a product, you produce a product and then sell it, convert it back into cash. So these are some indicative examples of long-term and short-term uses. So in a business, we use it, short-term use is for raw material and power, fuel, labor, consumables, repairs and maintenance, administrative, and sales and marketing. Whereas in a long-term, land, water, air, it's infrastructure, then essential buildings, machinery and equipment, office furniture, contingencies, and others. Sometimes sales and marketing expenses incurred before going into commercial production is also classified as long-term expenditure. So some examples, this require a lot of explanation, but still I would like to read them out just for information. Long-term sources of money are equity shares, retained earnings, preference shares, debentures, loans from banks, loans from financial institutions. Medium-term loans are loans from banks, public deposits, loans from financial institutions, and lease finance. Relatively, long-term sources of money are cheaper and relatively less, they carry lesser interest. So when you want to use something for a long-term purpose, there has to be source coming from long-term source. The money should be sourced from long-term source. Then in case of short-term, we have trade credit, short-term sources of money, trade credit, banks, working capital, cash credit or overdraft, then commercial papers, then factoring, and we have different classification. I trust you will get a copy of this PowerPoint presentation on your desktop through email. So they are high risk capital or high risk money, therefore they're expensive. Interest rate is very high. So obviously it leads to a simple analysis or second principle. Second principles of finance management. When you have use of money, we should divide it into long term and short term. For long term use, you need to get money from long term source only. When you want to use it for short term, you should get money from short term source only. Never ever divert short-term funds or short-term sources to long-term purposes. This saps you out of cash and creates liquidity issue. In my experience, the simplest experience the simplest example I can give you is I've seen farmers making sales of their crops and investing a part of their money, their sales proceeds into bore wells. This is that's where you find most of the farmers getting into liquidity issues exactly during the crop season. This is my observation over a period of 25 to 30 years. There are many such mistakes they do. They borrow from relatives and friends and on short-term basis and put it in purchase of tractor, purchase of jeep, purchase of vehicle. Although there it is their independent decision, but it is a wrong decision to invest short-term sources of money into long-term purposes. The other simplest example is your own body. Your own body gives you a fantastic example of finance management. Now you see in this body, the bones and muscles are like factory shed. So all the parts of the body are like factory machinery. And you see, you have accessories to it, like you wear a clothing, you wear so many things. They are all other expenses like furniture in the office and contingencies or whatever you want to decorate yourself with. So this is generally long term in nature. As a child, you are born and then you are groomed for 21 years. Your body becomes stable or your factory is ready, and then you go on working to earn money. So long lasting assets are created out of long term use. Now, when we look at the other side, liquidity is just like blood in your body. Cash. The cash should be there, which gets converted, which is used in purchase of raw material, labor, consumables. Then processing happens, a product is developed, it is packed and sold to generate cash. So cash is like blood. It should move like a liquid inside the factory to all parts of the body in enough quantities. Imagine if blood stops going into your little finger, what happens? There is inflammation. So same way, if the cash stops in any part of your factory doesn't convert itself into cash, extra cash again, then you have a issue. That issue is called liquidity issue. So the second principle is very clearly never divert liquidity funds or short-term funds for purchase of long-term assets. For example, never use gold loan to buy vehicles or buy machinery or buy any other long-term purpose. Never use credit card for long-term purpose. Never use borrowings from friends and relatives on a short-term basis for long-term purpose. Never use more than 25% of your cash on long-term assets. Never use. So these are all basic principles and you need to follow them very meticulously in your day-to-day life. So remember always, startup is just like a human baby. It's a marriage of entrepreneur with technology. So you conceive an idea. Same way a baby is conceived. After 9 months, the baby is delivered in the form of a MVP. So same way a startup delivers a baby in the form of MVP. Then you groom the MVP, a pilot scale. Then you send the child to school to expose it to risk. Same way you are doing your MVP in pilot scale, exposing it to market. Then the child grows. Then one particular day it is capable of earning money. Same way your business startup becomes viable at one particular point of time. So the point between the conception of the idea to convert it into a commercially operating unit. When it when I mean commercially operating unit means you should be able to use 40% of the capacity that you have generated, created. So at the up to that point, we call it as moratorium period, and you need to very carefully plan your cash flow during this period very meticulously. It is required. I know many people say, sir, I don't understand. It is not that. When you get into business, you should understand. You should learn and understand. So it is as simple as that. Your startup is just like an infant being conceived, delivered, and then maturing at the age of 21 to be economically viable. Same way, you have a shorter gestation or a shorter moratorium in your business. So the third principle we are moving into is current liabilities and current assets is nothing but all your short-term payable, whatever money you're taken on a short-term purpose or a short-term use needs to be listed, which needs to be returned. If you have to give back somebody a money within a period of 12 months, you need to list it. Then whatever assets you have created, if you can return it back within 12 months by selling it within a short notice, that is called short-term assets or current assets. So the golden ratio here is 1 is 1.3. That is, your asset should be at least 1.33 times than payable money or short-term money to be returned to people from whom you have borrowed. These are the three golden rules you cannot violate. You should never violate. You should always try to follow this. Exceptional managements do occur, but everybody is not an exception. So you need to have these three golden principles in your mind. Now, this is a small example which I have tried to create. Your own capital and investors' money is about 1 crore. You have borrowed 3 crores. Your current liability or money to be returned within 1 year period is 1 crore. So total sources of money is 5 crore. On the other hand, you have non-current assets or long-term assets at 3.67 crores, current assets at 1.33 crores, altogether 5 crores. So this is the ideal balance sheet where the ratios are protected. If you see 1 crore to 5 crore presents you 1:4 ratio. That 1:4 ratio, 1:3 is a long-term ratio, 1:4 is a outside liability ratio. Here also, if you see current liability to current assets is 1:1.33. So in order to sum up this issue, money is created by use, demand, supply, and legality. It represents cash, products, assets, and services. For summarizing, the management protect capital, net worth, and keep it growing. So you need to grow the capital, not pay so much attention to taxation, except to the required level. But your capital growth is the paramount importance, not the taxation. Capital growth you need to protect and you need to grow. So you create more value for yourself. Your share will be more in the company. Liquidity protection is second most important item. Never use short-term funds for long-term purposes. Priority give it to productive assets. Do not create unproductive or non-priority assets. I have seen in 1992 floriculture units which came up as startups in and around Bangalore. They all died in 5 years because they had created assets, something like a guest house for of the five-star nature with swimming pool and all that in a polyhouse structure. Why do you need all these things? Unproductive. Then you should have a grip on productive cost, a quick turnover, and repeat the cycles as early as possible. Now, I will skip this particular thing. Even then, let's try to understand very quickly. There is a continuity of business. One is
So,
commercial opportunity. Sorry,
yeah. So sorry to interrupt. I just want to let you know that you got 2-3 minutes to wind up because of the time constraint.
you have 2 minutes, or my time is up.
Actually, the time is
Yes, sir.
up,
You
but
can
you
take 2 more
you
minutes,
can
not an issue, sir.
you can take
Uh,
2 more
just
minutes.
just one more
Yes,
slide, and
sure,
I will
sure,
stop it. Okay.
sure.
First and foremost is commercial opportunity. It's nothing but market research, technical ability, that's your technical capacity, and then financial viability, profit motive, and money making. But never forget to plan an exit plan. Many people forget about this. Exit plan is most important, and the best example is Abhimanyu in Chakravyuha. Oh, Abhimanyu knew about entry into the Chakravyuha. So we all try to know how to enter Chakravyuha or business arena. Business arena is nothing but Chakravyuha. So if you don't know how to exit that business arena safely and successful, then you will meet the fate of Abhimanyu. You will always be claimed as a great person who went into business, but he failed. That's the way people will talk about. The corollary is only for management purposes, nothing else. Now, lastly, this is the last slide, and this is what I wanted to present. In your business, you need to have these three product types always put into your production line. We see them as stripped down versions and then improved versions and highest versions and all that. Now, you see, the best way I can explain to you is the first part is a high value, um, low value, high volume product. That's the rice, dal, roti, and raita is all constituting what we call as high volume, low value product, which gives sustaining the body. You can sustain yourself with this. They're cheap, but in large quantity. Come to the second one, that is the proteinous food, or we call it as medium quantity, medium value products. So this is required to maintain your body as proteins. It supplies proteins and ensures that your factory or your body as a factory is maintained very well. The profits gained out of this product line always helps you to sustain your production system, whereas the first part gives you sustenance. You are able to sustain and continue. It is the last part, which is called high value, low volume product, or a jamun in your thali. which makes whole platter complete. When you eat jamun, you get the sugar rush and you proclaim, ah, kya food tha, kya meal tha, wonderful meal I had. And that's where high value, low volume products come into picture in your enterprise. That's where you need to plan a full platter of products in your business, in your startup. If you see, most of the mobile phones have always started with a sustainable model, then a medium value, medium volume model, then high end volume. So this is all I wanted to present in terms of simple understanding of finance management. Thank you very much for listening. If you have questions, I will take it anytime.
Uh, Thank you, sir. Thank you for your presentation. We'll be
I did
taking
it
up
in 30
questions.
minutes.
Yeah, we'll be taking up the questions, but during our Q&A round, we'll now quickly move on to our next speaker for the day, Dr. Vimal Pant. He's working as Associate Professor at National Institute for Technology, Entrepreneurship and Management. His specialization lies in the area of finance and entrepreneurship. Uh, Dr. Vimal Pant, I request you to take over the session. I have also made you the presenter. He left. Okay, there he's here. Just we can see your screen.
Okay, so a very warm welcome to all the people who've joined in this session. So a lot of things have already been covered in today's talk. So I'll cover some basics of cash flow, because what happens is that many times we hear that a business is doing well, but because of it being cash strapped, sometimes it's not able to grow, or it has to wind up. So let us first try to see why this cash is important and what are the areas or how we can plan to have a healthy cash flow in our business, right? So essentially, if I say what is cash flow, so it is movement of funds in and out of your business. So there's cash inflow and there's something called cash outflow. So what happens is that many a times there is a mismatch between these two. So ideally, outflow means when you have to pay your liabilities. Okay, and inflows means whenever there is revenue or any other income trickling in. Okay, so the way cash flow is to be managed is that whenever you have to pay your liabilities, you are never out of cash. Okay. So why this cash flow management is important in any business? So the first thing is what we need to understand is that profits, many times people believe that if a business is making profit, it has enough cash. Actually, this is not true, because you see, profit is reflected in your accounting statements, and accounting statements are accrual based. Okay, while cash is represented in your bank statement. So many times what happens is that especially if you're a new business, you might not have profits, isn't it? Why? Because sometimes what happens, you need some volume to reach that break even. And sometimes initially you are spending a lot to acquire customers, reach new markets. So if you don't have profits initially, that will do. But if you don't have cash in hand, then your business will stop working. So what I mean to say is that initially you have to see that profitability is okay, but liquidity is more important, right? So why understanding of cash flow helps? So any entrepreneur or any business owner should have a good understanding of the cash flows for his business. Why this is so important? Because if it's a new business or even if it's an existing business, any business has to grow, otherwise it will not survive. So when you are growing your business, if you don't have proper cash management, you will have a lot of hardships. You will have to compromise, or sometimes you might also collapse. Okay, so that is very important. Then every business has some future planning. Okay, so if you want to expand your business, you want to hire more people, you want to increase your team members. So For all these, you need a budget. You need to know about where the funds will come from. So unless I have a good cash flow management in my mind, both current and future, then my future planning would not be proper, right? Then sometimes, as you know, business is dependent on a lot of macro environmental factors, external factors which are beyond our control. So for that means you can have some seasonal ups and downs. So to tide over any emergency situation, you should have a good preparation, or you should be better equipped, or you should have some buffer. So for that also you need cash flow. Okay, so I'll just a while later we'll see what we can do to achieve this. But first, let us understand. As I said, there's cash inflow and there is cash outflow. So first, let us see what are these activities in which there is a cash inflow and there is a cash outflow. So primarily, we find that there are three kinds of activities. One is investing, the other is financing, and third is the operating. So all your cash inflows and your cash outflows will happen under any of these three activities, be it the investment in the business, financing of business, or operation of business. Okay, so let us have a quick look at what these actually are. So investing activities means whenever we are buying any long-term fixed asset, or whenever we are investing in a long term. So anytime you are purchasing a property, plant, equipment, or you're investing in a long-term asset, that is called as investing activities. Okay, so if you are buying these things, there is cash outflow. If you're selling these long-term assets, like if you're selling some plant or machinery, if you're selling some piece of land, if you're selling some building, so this is inflow of cash. So acquisition of these long-term assets is outflow of cash, and sale of such assets is inflow of cash, right? So this is the first activity which will involve cash outflow and cash inflow. The second type of activity, okay, so in investing activities, but how do we manage cash, or how do we find out whether investing activities will be okay or not? What we do is the technique is called as capital budgeting. So what we do is we find out projected cash flow. Like suppose if I am buying say a machinery. So how to take a decision whether I should buy this machinery or not? What I'll do is I'll prepare a future cash flow statement. That means what cash will be generated by the business if I buy this machine. Based on that, if I find that there is a surplus between what I invest and what I get, the decision will be yes. But if I find that the cash generated or the surplus generated by this investment is not as good enough as I would like, then I'll say no to it. Okay, so this is the first part. The second type of activity is financing activity. So investment is what? When you are buying certain assets. Now, financing is bringing money into the business. That means if whatever you are buying, from where the money will come. Okay, so what happens is, as I think sir also explained you in the earlier presentation, that business gets money or funding from two sources. When the owners bring in money, that is called as equity. When the outsiders bring it, it is called as debt. Okay, so equity or debt, both will lead to cash inflow and outflow. So when people are investing in your business, or when people are say giving you loans or debts, that will lead to cash inflow. But when you are repaying, if you're repaying your debt, you're paying EMIs, that will lead to cash outflow. Okay, so this is the second activity. The third one, and which involves majority of transactions, is your operating activities, right? So because why? Funding you don't get every day. It happens on few occasions, or say sometimes maybe once in few years, right? Investment. Similarly, financing activity, investment maybe once or twice in a year, or maybe not that frequent. But operating activities, it happens every day of the business. Okay, so that means all those revenue producing activities, like all your operating expenses that you incur. So like, for example, when you When you're selling goods, there is cash inflow. When you are incurring your expenses, you're paying your suppliers, you're paying salary, you're paying wages, electricity, distribution, marketing, advertising, legal expenses, whatever. So these are cash outflows. So incomes are inflows and expenses are outflows. Okay. So now we know that these are three activities: investment activity, financing activity, and operating activity. So what we do is, how do we know as to what, when, and how much cash will be required? So because I'm principally dealing with cash, so I need to know, because these three activities will happen according to the needs of the business. So what I do is, I need a tool which can help me to know as to when and how much cash will be required. So what we do is, we make a cash budget. So this cash budget is nothing but it's a forecast of cash inflows and cash outflows. So normally in the bigger organizations, it is done on a monthly basis. So you can have it according to the scale of your business. You can have it, say, quarterly, but cash budget is, it's a proactive measure. Why? Because it helps you in a lot of factors, like determining what are the future cash needs of the firm. Like, this is August. So if I have some payment coming up in November, I should know now, so that by the time the month of November comes, I'm ready with my cash. Or if I'm going to receive some money in November, I should know so that I can match it with my payments. Okay, so I can plan for my financing of my business needs if I know my cash budget. And plus, it is also a controlling or monitoring tool. Why? Because so that I can know whether there are any defaults, whether whatever cash was to be receivable, whether I have received or not, whether whatever were my payables, whether I have paid them or not. Right now, so what if I have to make a cash budget? What do I know? What I need to know is, I need to know as to what will be my cash receipts and what will be my cash disbursements. So I have to, in order to make that cash budget, I have to make a forecast. So for that forecast, cash receipt normally is what? Mainly it is your sales. Okay. So, sales are dynamic in nature. So sometimes sales are seasonal, like festival season coming, there will be a lot of sales. Sometimes, there are some dry seasons where sales are lower. So I need to know, and sometimes, because of consumer decisions, competitions, macro environment changes, there might be. So cash budget is dynamic. So your cash receipts, you have to carefully plan. Sometimes you might have to change according to the change in the environment. Similarly, cash disbursements, like as I say, suppose the market is dull. What happened during the coronavirus phase? So there were, all the investment activity stalled. Why? Because the demand, the consumer sentiment is low, the markets are not fully functional, so there's no point investing right now, isn't it? So depending upon your micro and macro factors, you have to decide. So your receipts and disbursement. So cash budget is a forecast which is very dynamic, which is fluid, and which keeps on changing, right? So how do you make this cash budget, or what are the steps? So first, you can have a template. You can use Microsoft Excel, or you can use any other software. There are many good softwares available these days for all your financial management needs, including your budgeting. So use that software. Take a time frame. So normally you can make a cash budget for 1 year at least, so that you know what in each quarter, what will be your requirements. Then you should have some target cash balance. That means how much is the average cash requirement you should always have in the bank. This is the minimum amount of cash you should always have in the bank. Okay. So you will know that, between cash receipts and cash payments, this is the surplus that you always need. So this cash balance obviously will average will depend upon the nature of your business, your payments and receipts frequency, and other contingency requirements. Okay. Then you start with your opening balance of the cash, whatever cash you have now, plus whatever inputs or whatever receipts you have minus whatever payments will you have, and that should lead to your target cash balance or your closing cash flow. Okay, and based upon that, you can forecast all your inflows and outflows. Okay, so that means this way, and you can start your cash budgeting process. And once you have done the projections, you have the cash flow statement with you. This cash flow statement which is generated can always be used to track and control, uh, whatever sort activities you're having, or to ensure that cash flow management is optimal. Okay, now finally I'll discuss the final some of the suggestions which you can use to improve your cash flow. That means you should, if you can identify your business risks and prepare in advance for that. Business risk means particularly related to your business. So if you can well evaluate and prepare in advance, it will help you. Then try to speed up the receipt and processing of your receivables, because most of the sales are on credit, they're not on cash. So you have to see that there is an effective receivables management. Try to keep your inventory levels lean. That means don't get your cash get stuck up in stocks, too much. To try to keep them as low as possible. Then you should avoid giving credit to customers which might default. So for that you have to assess the credit worthiness of the customers. So that means you do some due diligence. You should try to keep away from customers which can turn out to be bad debts. Then those customers which are paying you regularly, which pay you in advance, or which take a very short period of time, you can offer them some incentives like some discounts. Okay, then try to cut or delay spending where you need to, like you need to pay to your creditors, your suppliers. So try to get the best deal out of them, as to try. So the effective cash management is what? Try to delay your payments and try to speed up your receipts, isn't it? And then what you get is called as a cash flow. So the better is this the lower will be your cash requirement, the better you manage it in this way. Okay. And one more advice for entrepreneurs, that they should not mix their personal businesses with that of the business. Many times you see what happens is that small entrepreneurs normally tend to mix both of them, and due to which sometimes the business has to suffer because you are meeting some personal liability out of the funds given for the business. Okay, so that is. Plus, as I said, you should keep some buffer cash for rainy days. That means sometimes, as you all know, we tend to forecast, we tend to identify risks, but there are situations which are, like what happened in 2020 due to that COVID scare. So nobody could fathom such a scenario, right? So you should always think that in the macro environments, anything can happen any day, for which you should have some buffer with you. Okay. So in the end, in a nutshell, I'd say that for any business, you need to put your cash flow above profit, because even if you're profitable, but if you don't have cash, your business might suffer badly. Okay, so cash always should get a priority over your profit. So I think that's all we have time for. So thank you.
Thank you very much for your both the talks, and we got a lot of information, sir. The most important thing for agri startups, because most of the founders lack direct financial knowledge. What is your suggestion? Would they find a teammate or a founder with a financial knowledge, or should they put a consultant, or rely on a CA or a part-time kind of a role, or should they onboard a mentor or advisor? Can you please suggest, sir, how they should go about it? Probably both of you can answer in the same order, sir. So you are on mute, sir. Kindly check.
My suggestion is learn. It is simple. It is simple. In fact, as a BSc Agri graduate, I learned how to use Tally. I learned how to use, earlier there was a very initial programming. This thing. Learn something you will understand very easily. These things are easily possible. It is better to learn than appointing many people, and you always pretend that you are seriously engaged with technology or product development and all that. That is all true, that is all required, but then without financial knowledge on a long term basis, it is difficult for a startup in agriculture. I'm talking about agriculture. You learn, it is simple, easy. Agriculture startups are very weak in nature. Generally, they are very weak. Either they do not have a proper market research, then do not plan their demand properly, or do not develop their prototype early, and they are most of the times missing that early bird opportunities in commercial platform. Therefore, my suggestion is learn side by side. No simple things. As I said, capital growth should be priority. How much money you can generate on your own is priority. Product, how quickly you can launch your product and start making money. I'll give two examples here. One, there's a guy mentored in 2018 as a startup, and he was given 20 lakhs. Till date, he has produced only 3 units. Even after 5 years, his soil testing unit is only 3 units are produced, and he keeps giving lame reasons. And later on, we found out that these people had fight between the partners and they had exited. Some people had exited. The money invested did not result in completing the project. So there are lots of such cases where people fail to understand that making money is priority. Therefore, you need to bring your product into business as early as possible. Simple finance management, learn tally, you will be all right.
Thank you, sir. Vimal, sir.
Okay, so my advice is that when you are obviously, when you spend years into the business, these things you learn. But when you're when you're in the starting phase, because you're focusing more on the product marketing and all other things, so what obviously you can hire a specialist, but in this era, there's a lot of YouTube content, online content. So there's some major, say some key aspects or key concepts which you can learn through these. Key detailed, suppose you have to make financial DPR, in which you have to calculate a lot of ratios, projections. For those, you can take the experts of a chartered accountant. But at the same time, what my experience is, because I've been in the banking industry for around 10 years, what happens is that these entrepreneurs or small business people, they could go to a chartered accountant and just tell them, please make a DPR for us. We have to submit in the bank. So what the chartered accountants do is that they have templates already in with them. They just feed in the figures and hand over a report to them. Now the entrepreneur even doesn't know, what is his sales projection, what are his expenses projections, what is his debt service coverage ratio. So what I'm saying is, maybe you are not able to make the statements, but you should know what is the information in those statements. Like if somebody is asking you, what is your net profit ratio, so I should know how much margin I'm making and what is there in those statements. So I think initially, as I said, there's no shortcut to learning. You should try to learn the concepts beforehand, and along with, you can have an expert who can help you in making those statements. And as your business grows, obviously you will have your internal staff for that specialized function, and you can discuss with them, and the knowledge will grow upon you. So like, suppose I'm going to a sweet shop, so I know I can't make the sweet myself, but I know what are the ingredients in it, how is it made. That thing, if I know, I think that will suffice.
Wonderful.
Thank you. Thank you very much, sir. So one more thing is the management of a cash flows. Typically, once you have a suppliers and at the same time you have your customers, these cash flows, when these credit periods does not match, this is the biggest problem for many of the startups. So his supplier says I'll pay after 90 days, whereas his customer, when he says that I want money immediately, the supplier, customer says I will pay after 40 days. So how typically we should act in these situations? Can you please give your suggestions, sir?
It's a when the rest of the people this region is seeking. Suggestion is in agriculture. In agriculture, you need to plan what we call as seasonality of the product. You need to know the season when your demands are high, when your demands are low, when the raw material is available, when the raw material will be costlier. So now, once you know this, you are able to manage the major part of your cash flow, that is the procurement of raw material. And then my suggestion to you is always keep working capital of 2 cycles in reserves. In reserves in agriculture, it is very badly needed. Working capital reserve, I call it as working capital reserve because you need to have at least 3 cycles of working capital fund to be separately kept because uncertainties are too many in agriculture. And when it comes to management of creditors and debtors, it is the utility that you create for your product. How useful is your product? If your product is useful and it is creating a demand and people are buying it, you will see automatically the dealers or persons who want it on credit going a product in order to be in business. Therefore, there will be a reduced cycle. And in the same way, if your product is so good, people are willing to give you on credit, or they will come to your this because they will get a continuous order. So it's ultimately your product that creates utility and demand. That major role in management of the creditors and debtors. Let me give example of Tata Nano. See, the Tata Nano car was based on research, whereas the ACE track, on the other hand, it was based on a lot of research. So the demand was not properly assessed and a product was released. There's one product in the same company which is zooming in business. There's another product which is in the same company, not ready to take off. So obviously you find stock is hesitating with Tata Nano. Stock is belligerent and bullish on stocking ACE track. This gives you example of how your product should be, how quickly you are into business, what quality of product you are giving into the market. Otherwise, it's very tough for anybody to negotiate on creditors and debtors management. Negotiation is the key only when you create a huge demand for your product. Thank you.
Thank you very much, sir. Vimal, sir, please.
Okay, so as sir said, if you go to a bank for limits up to 5 crores, normally you get 25% of your requirement as working, of your sales turnover as working capital. So it is 4 operating cycles, you can say. But for as you were saying, for a new business, you cannot control the creators. You have to because you are new and you are yet to prove your credit worthiness. So obviously, initially your credit terms will not be as good. But so what you can work is on the buyer side. So if you can try that, you can to the distributors, you can help them with receivables, and with if you can have customers with some you can give them incentive for because in the earlier stages profit is not important, cash flow is important, as I said. So in the early stages, we have to work on the buyer side, try to find out buyers who are credit worthy, try to find buyers who can pay early, try to find distributors who have good financial health, so that they are not stuck up with your payment. Because sometimes what happens, if the distributor is not financially sound, maybe your product has been sold but he'll delay your payment. So thing is, as I said, cash budget is a tool, but cash flow management is to be done initially on the by taking finding out efficiencies on the buyer side. And as your sales grow, and as your per your track record, and as by the passage of time, your suppliers will realize that you are a partner with whom they can trust. I think they'll come up with some favorable terms. So it's like initial days you work on the buyer side, and after a good track record, the suppliers will follow.
Thank you very much, sir. So one question from directly we'll take from any of the attendees here before we wrap it up. I would request Gina to unmute anybody raising their hand. Any participant would like to interact with the speakers today, kindly request you to raise your hand here. Webinar. Okay. We'll take one chat question only, sir, because they have time. What are the criteria for typically when you evaluate a project in terms of investment? Somebody want to put in the money. What happens nowadays? Everybody is doing a startup. They'll go to their friend and ask for money. Let's say I am making some certain money. I save a lakh, or instead of putting in a fixed deposit, I would see a startup as an opportunity. So what kind of factors typically we should consider to go there, sir? You can give us the fundamental things probably. So before we wrap it up, thank you, sir.
So the fundamental is in the pilot scale, how good you are, pilot scale, or how best is your product researched upon in terms of commercial research. A market research is fundamental to startup. To have an idea whether it creates a demand is a very, very basic and most required this one. I've come across, we screen almost 1,000 startups every year. When we screen that, we find that these people do not even go to the market. So go to the market and study. It's very hard thing, but initially you need to do it. You need to do it. Without that, there is no exception. So market research and whether your product can create a demand is what you need to know. Now, second thing I would like to tell here, a guy from a startup has 80,000 clients, and now he is incurring 48 lakhs per annum expenditure. 80,000 clients using his app for to the level of almost 10 lakhs, 10 lakh transactions per annum, and he is not able to break even. Unimaginable, unimaginable. See, 10 rupees per month per client as a user fee could create his market to a better level, but he is not able to even create that kind of giving anything free, not getting into money making mode as early as possible. See, the startup intention is to change the habit of people, the way they use your utility or your product as a changing type of habit. And it should happen with a large part of the community, like Zomato. What it did, it changed the habit, the way you are eating, created ripples in hundreds and thousands of people. That kind of creation is required. Paytm, the way it changed your habit of making payment. So changing habit as early as possible, making money. The moment you launch it commercially, you should start making money. Focus on that. Once you get taste of money, you will run after it. So all your problems will be over with that kind of a habit. You need to change your mindset from being a developer, a kind of I'm the creator, I'm the creator. No, you are a creator, fine, but you need to go ahead and make money. So that mindset is required to be changed. In my opinion, commercial research, without that, please don't enter startup business.
Thank you, sir. Vimal, sir.
Okay, so fundamentally, I think what you're asking is that suppose if you go to an investor with a project, and how does he decide whether to invest in your project or not? I think that's what you asked. So any startup or any businessman going to an investor, the investor is looking for returns. Okay. So primarily, as an investor, I want returns from my investment. Those returns are directly linked to the risk which I'm taking. So the risks inherent in your business. So if your project seems risky, I want higher returns. If it is less risky, maybe I'll compromise on low returns. So now, the first is the risk of the project. Every business has risk. No company in the world can say that any business is without risk. So, what returns I'm demanding as an investor will depend upon the risk perception that I'm having about your project. That is number one. And secondly, my confidence in how well you can execute that project. So these two factors will decide whether I give you my money or not. So the issue is how much risk you have and what capacity or capability you have to take that risk. So if you can satisfy me on those two counts, you can get the money.
Absolutely right.
Thank you, sir. Thank you very much for sharing your experience with us. I hope our participants also gained some knowledge. We'd like to thank both the speakers for taking their time out here. So we'd like to thank our Director General Manager, Director Agriculture Extension, Dr. Sharunan Raj, and our CEO for the center, all our team, Jeenat, Neha, and Srinu, and other people being here. Thank you very much. We look forward to your presence in our upcoming webinar. Have a great day ahead.
Wonderful. Thank you very much. You have a great day too.